If you're worried about the stock market and you've been thinking about timing an exit from your investment soon, then you're going to want to watch the rest of this video. I'm Stephen Rashall, and I'm helping you get smart with money. Welcome back, and thanks for tuning in to another episode of the Smart Money Show. I'm your host, Stephen Rashall, and today we're going to be talking about market timing and if now is a good time to be selling your investments. Now, over the last several episodes, we've talked quite a bit about COVID-19 and the effect that it's been having on the global economy. You keep hearing more bad news about the health issues, more bad news about businesses, the unemployment, and more bad news overall just about the global economy. We're probably in a recession right now. Remember, recession is 2 back-to-back quarters of contracting growth. So far in the first quarter of 2020, that was true. We're in the second quarter right now, but it got so bad so quick that most people just at this point assume and acknowledge that we're probably in the midst of a recession, but you can't call it official until the end of the second quarter here. So that being said, does it make sense to be thinking about selling your investments now? And why not just buy them back later? You could sell now and buy back later, right? Especially if there's going to be a second wave of the coronavirus and if that's going to have a big effect on the economy again. Who knows? Sounds like an easy and simple plan, but it's not. Because you have to be right twice, right? You have to be right when you sell, and you've got to be right about when you're buying. This is called market timing. And just so you know, no person and no computer has ever successfully been able to market time over the long term. And that's because you can't predict the market. The stock market is random. Let's look at a few examples. We just had recently some of these really bad record-breaking days in the stock market as part of the COVID-19 pandemic. But here on the screen, we have October 19th, 1987. This is the original Black Monday. This was the worst single-day percentage drop ever, and it still is. The S&P 500 dropped 22% in a single day. That's a lot, 22% in one day. So how would anyone have known if that happened on a Monday that the week before on Friday they were supposed to sell all their investments? And oh, by the way, that's when you're supposed to sell. When you're supposed to buy back in, look what happened over the next 2 years here. You should have bought back in basically right away or within a month because, the stock market was then up 54% over the next 2 years after Black Monday in 1987. Right? But the stock market doesn't normally move that fast. And that was a situation where the market went down abruptly and then it recovered pretty quickly and went on to recover on at a very, very steady rate. What about something more recent like the financial crisis and the Great Recession? Here's that chart. Now that lasted over a year and a half from October of 2007 to March of 2009. So look at the chart. Think about it. When would you have actually sold? Would you have sold in, May or maybe in June when the recession was actually official and it was called? Would you have waited a little bit longer till things really heated up and we had all the bank failures and other issues going into September and October? I mean, I don't know, right? That's market timing. And I have no clue when you would have been able to make that call, especially during the financial crisis. Not to mention, when would you have then got back in? And now with the coronavirus, certainly you have people out there that sold some of their investments before COVID-19 really wreaked havoc on the markets. But remember, going into this, the global economy had really positive momentum. So from the peak in late February until March 23rd, 2020, the S&P 500 lost more than 30%. That is a really, really quick drop over a period of about a month. Do you remember how you were feeling in late March? Were you thinking about hitting the exit button on your investments? Well, hopefully you didn't do that and you stuck with your long-term investment plan. Because a month later, after March 23rd till then April 23rd of 2020, the S&P 500, it was back up over 25%. Now look, that's still lower than the peak in February, but it's quite a recovery so far. So look, do you think that the people that sold their investments predicted that March 23rd would be the day to buy back in? Probably not. But then again, maybe some of them are still concerned the market is going to drop even further And maybe they think that's going to happen soon, and maybe they're going to be right, or maybe they're going to be wrong. I have no clue. But what we do know is if you did sell your investments, you just missed some of the best days ever in the stock market. And that's not good for your portfolio long term. We did some research because we wanted to figure out what would happen if you just happened to miss some of the best days in the stock market. So what if you're market timing and you got out of the market and you just missed some of those best days? Well, I was really surprised when I saw these numbers. Here they are. We looked at the 15-year period ending with December 31st, 2019. And here it is. If you just stayed invested in the S&P 500 over that entire period and did nothing, so you went through the recession, right, and just did nothing, stuck to your investment plan, you would have averaged a 9% annualized return. So on $100,000, you'd have $364,000. But if you missed just the 10 best days, right, that's 10 days out of a 15-year period, 10 days. If you missed those 10 days, you would have done less than half as good. 4.1% would have been your average annualized return. You missed the 20 best days, you're barely eking out a gain of 1.7% annualized. If you missed the 30 best days over that 15-year period, you're now in the negative. You actually lost money. Wow. Well, I want to know what you think of that. I mean, did you expect the numbers to be that big of a difference? I want to hear what you think. Leave me a comment. Tell me what you think about that below. Now you see, or you're starting to see, why it's so hard to time the market, right? You have to get lucky not once, but twice. And that just sounds like a lot of luck, and you just can't predict the market. Nobody really knows what's going to happen tomorrow, what's going to happen next week, or what's going to happen next year. So think about this, right? We have all this bad news, a contracting economy, record unemployment, but the stock market is still going higher. Why? Well, we're going to talk about that and more on an upcoming episode here of the Smart Money Show. Bottom line, don't try to time the market. With market timing, you have to get lucky. You have to get lucky when you sell. You have to get lucky when you buy. That's just way too much luck. Ultimately, it's time and not timing that's going to determine your success with investing long term. Those are just the facts. So hey, if you learned something new, please be sure to share this with your friends, your family, your loved ones. Give us some love. Give me a like. And you know what? Remember to subscribe and follow the Smart Money Show so that way you can be in touch and see when we have our latest episodes that come out at least every couple weeks here on the Smart Money Show. Until next time, I'm Stephen Rochelle, and I'm helping you get smart with money.